So guys, it looks like the Fed is losing its fight with inflation. A new set of U.S. inflation figures released last week that showed stubbornly elevated prices, raising questions about whether the Fed's interest rate increases are missing the mark when it comes to taming inflation. More and more experts have been pointing to corporate pricing, energy costs, and disruptions in supply chain as the true reasons behind our high inflation figures. The news is adding to fears about the needless economic pain that would result should the Federal Reserve drag the United States toward a recession, and it sure looks like that's where we're heading. In today's video, we're going to take a look at the latest inflation data and its implications, so make sure you stick around for this one. So the Federal Reserve and some economists continue to believe that the demand generated by hot labor markets and rising wages has been driving inflation, with higher unemployment and interest rates being the magic cure-all. The Fed raised rates 5 times in 2022 and indicated that more increases are coming. Jerome Powell, Federal Reserve Board Chairman, has acknowledged that this would cause some pain for households and businesses. Other economists believe that raising interest rates isn't working, and excessively aggressive actions by the Federal Reserve are pushing our economy towards the edge of not just some pain, but of devastating recession. And they suggest that supply chain bottlenecks, the unstable global energy market, and rampant corporate profiteering cannot be solved with more interest rate increases. Now, that being said, there is some data showing that the Fed is making some headway on the goals that they have. The housing market has certainly been cooled off, with mortgage rates skyrocketing, forcing home sales to fall. Meanwhile, recent jobs data shows that there has been a steep drop in the number of job openings, along with slower jobs and wage growth. But CPI figures for September reveal that this method has produced little price gain. Inflation tickled up to 8.2%, compared with an increase of 0.1% for August and 0.4% in September over a 1-month period. Now, former Fed economist Claudia Shame recently remarked that the price drops aren't materializing because current inflation largely isn't demand or labor driven as often as it is during inflationary periods. And high inflation is not workers' fault, but the Fed is waging a war on U.S. workers. The vice chairman of the Federal Reserve Board, Lael Brainard, also acknowledged the role of price fixing and disruption in supply chains in her recent address to the National Association of Business Economics. Brainard noted that profit margins at retailers increased 20%, which is about twice as much as the 9% rise in median hourly earnings of workers in that industry. Now, in the automotive industry, margins on vehicles sold in dealerships have increased by over 180% since February of 2020, or roughly 10 times as much as the rise in the sector's average hourly earnings. Brainard believes that returning margins to more normal levels in the retail business can help to alleviate some inflationary pressures on consumer goods. So an analysis published in April by the Economic Policy Institute, which is a progressive economic think tank, puts numbers behind the theory that corporate pricing are an inflationary force. Prices rose by more than 6% annually from Q2 of 2020, which is up from 1.8% in the business cycle before the pandemic in 2007 to 2019. EPI broke prices for the financial sector, business sector, down into 3 broad components: labor costs, non-labor inputs, and then margins. Now, Josh Bivens, the author of the EPI report, claimed that, and I quote, "More than half of COVID's recovery era growth can be traced back to a larger profit margin, whereas labor costs account for less than 8%. Companies are taking higher inputs, putting a bigger markup on them than they were previously, then passing that on to customers. That is almost a complete flip from what was seen in the decades before COVID." Bivens said a surge in demand for durable goods, coupled with supply chain issues, has created an enormous amount of pricing power for companies that hold inventory. Many solutions to supply chain problems are geographically complex, such as the U.S. efforts to put a ceiling on Russian oil prices. The U.S. can also prohibit the export of oil to lower fuel costs here, but doing so would be devastating to Europe. The most significant move that the Biden administration has taken in response to skyrocketing energy costs has been the administration's new plan to use the standard oil reserve as a tool for controlling the prices at the pumps. And oil companies say that they are deliberately keeping output low and prices high because shareholders lost so much money over the past few years during the oil market's boom-bust cycle. Biden's plan is intended to provide market stability and provide incentives for increased production. Meanwhile, the U.S. Justice Department has launched an investigation on price fixing in the meatpacking industry, and new U.S. Department of Agriculture regulations are designed to encourage competition there. Whether those actions will have a positive short-term and long-term impact to inflation and the coming recession remains to be seen. Now, Peter Schiff, chief executive of Euro-Pacific Capital Inc., he contends that, bad as last month's CPI report was, it does not reflect the true seriousness of the inflation. He recently wrote that the Fed is losing its inflation fight and soon it will be forced to surrender. A recent Gallup survey found inflation is causing economic pain to 56% of Americans, and various surveys show inflation as the #1 problem heading into the 2022 midterm elections. Nick Tamiros, the chief economics correspondent at the Wall Street Journal, predicted persistently high inflation will force the Fed to keep raising interest rates in order to boost the cost of borrowing money and thus reducing economic activity, eventually bringing prices back down. Nick had this to say: for the Fed, the September CPI report seals the case for a fourth consecutive 75 basis point hike. It calls into question the modal outlook from 3 weeks ago that the Fed might be able to stop raising rates after 50 basis points in December and 25 again in February. It's looking like the Fed is going to be forced a hard landing, but they're trying to avoid stagflation here in the process. Whether these record high inflation numbers have more to do with things the Fed can control or factors outside of it, like corporate profits and supply chain issues, matters very little to the everyday consumer. How has inflation hit you guys personally? I know for me, it's every which direction. Has your budget taken a hit so far? Let me know in the comments below, what is the biggest pain point for you? Also, let us know what you think about the blame game going on here. Are corporate profits the reason for our recent inflation, or does it have more to do with supply chain issues or the Fed losing monetary policy, running way longer than it should have? I'd be interested, of course, to hear your thoughts. What political issue or side of the fence do you stay on? Of course, keep it friendly in the comments below. Certainly want this to be an open dialogue and something where we can have a friendly discussion. Guys, make sure you don't forget to subscribe to the channel if you haven't done so already. Like the video and share it with somebody who could use it. Until I see you on the next one, make it a great day and keep on cash flowing. Take care.